Hello, everyone, and welcome to another episode of the Real Estate Development Insights podcast, where we bring you ideas, experiences, and best practices from the real estate development industry. My name is Payam Noursalehi. I'm the president of Dena Project Management, a construction and project management firm that helps real estate developers define, design, and deliver successful projects. My guest for this episode is Jordan Nanowski. Jordan is CMHC's lead economist and spokesperson for the Greater Toronto Area housing market. He provides forecast analysis and commentary on development in the resale, rental, and new home markets. Previously, he worked as an international development economist and has published multiple academic papers in this field. For those of you who are not familiar with CMHC, CMHC is a Crown corporation in Canada, and CMHC stands for Canada Mortgage and Housing Corporation. In this episode, I'll talk to Jordan about the report that just came out recently about the forecast on the housing market in Canada, and particularly of our interest in GTA and Ontario section for the 2026 to 2028 period. And we're going to dive into the trends, the numbers, and some of the stats that are provided in this report. And I hope you find it very useful. As always, you can find all the information about this podcast episode and our guest on our website, realestatedevelopmentinsights.com, realestatedevelopmentinsights.com. That's all one phrase, and I hope you enjoy listening. Please don't forget to subscribe and also, preferably, tell others about us and help us grow the show. Thank you. Hey, Jordan, welcome to the show. How are you doing today?
Hey, Pam, thanks for having me. I'm doing great. It's a little bit warmer now, so I'm grateful for that.
Fantastic. Yes, we're definitely getting toward the end of the shoveling season, which I really look forward to.
Yeah, in any of that, I live in a condo, but if I did, I'd be much more grateful that it's over.
I think I shovel for the both of us, so that's okay. I'll take
Fantastic.
that burden. Why don't we start by you introducing yourself to our audience? Who's Jordan? What do you do? And we go from there.
Yeah, sure. I'll keep it short and sweet. My name is Jordan Nanowski. I'm the lead CMHC economist and spokesperson for the Greater Toronto Area housing market. I've been working with the CMHC since 2017, and throughout most of that covering the GTA in some capacity. So I'm glad to be focused on the center of the universe within Canada, at least. And it's a lot of fun. Us economists, some of the stuff we focus on or get really interested in, it's very like ivory tower, it's hard to convey it or get the average person interested in it. But I feel like real estate is just such a topic that like virtually everyone is interested in, at least in Canada. And people love talking about it. So it's great to have that as the focus of my analysis.
Yeah, we definitely feel the effects, the good, the bad, and the ugly of pretty much the economic effect of the real estate, the industry as a whole, and the construction sector for that matter, which is a big part of what we do. I'm curious, is this a normal path for an economist to fall into real estate development and housing market, or is this something that happened by chance?
A little bit by chance, and I'm grateful for that. I love the industry I'm in. I think as an economist, you have a wide range of fields you can go into, which is really cool. And I'm grateful that I just found myself in housing because, again, it's something that it's much easier to talk about housing economics at the Thanksgiving table than it is to like global macroeconomic policy, stuff like that.
I was just going to say, you're probably one of the very few popular economists at a dinner table. Like people really want to talk to you about. So with that being said, and I do want to talk quite a bit about the report that just came out a couple of days ago, and we're going to go through that. But there's one distinction that when you and I were talking offline, you made, which I think is also important for our audience to appreciate, is that we in Toronto right now in the purpose-built rental market, in the multiplex market, we hear CMHC, or at least I hear CMHC multiple times a day in terms of their role in the financing of these smaller projects. To be clear, what you do has nothing to do with the program, so we're not going to ask you. The reason I'm not going to ask you about the programs themselves is that's not your department, and we're just going to talk about data, market analysis, trends, and stuff like that. Is that cool?
Yeah, no, that's perfect. I'm very much shoeboxed into kind of the GTA housing market and what makes it like tick and how like what's going on and how everything is going to progress, and less so on the kind of specific program side. So that works quite well.
Perfect. So let's dive into that. We established that you look at the numbers, that you come up with market trends and forecast analysis. Can you walk us maybe through how you do that? Because then I think that how would bleed and open up a whole bunch of other conversations that we go from there. How do you guys come up with these trends? How do you track these metrics? And we go from there.
Yeah, so it's something I just do entirely from start to finish. I'm blessed with, we have a very big kind of division with a lot of economists that work on the macro side. We do analysis at the national level, at all major CMA levels, at the provincial level as well. It's a team of a lot of macro economists, and then you have myself, and then the GTA has a few other economists that kind of go through all the data for at even like the micro level for like different CMAs across Ontario and stuff. So it's a wide team. We work quite closely with our kind of national forecasters to understand what's going on there, because ultimately that's driving a lot of stuff across like the GTA has a lot of unique things that make it different from the other major CMAs across the country. But the one thing that we all have in common right now is larger macroeconomic factors that are outside of the constraints of each individual city, right? It's a lot of economists doing a lot of analyses at different levels. I used to be the one kind of like deep in the weeds and running the regressions and doing the modeling. I'm not that individual now, luckily. A lot of my job is getting market intelligence, meeting with stakeholders, learning stuff like that, being the bridge between kind of our actual modelers and analysts and outside of the ivory tower, and working with them to figure out exactly what's going on. So we're meeting both quantitative and qualitative and pushing out those forecasts that way.
So that's where I want to go with this, because I think with the conversation that we're going to have, it's going to hopefully have a great impact on shaping the decisions for a whole bunch of our listeners in terms of what they do over the next few years. So I think it's important for them to also understand the background of how these numbers, these trends, these forecasts coming up. And in other words, like it's a forecast, it's not a prediction. It's some part, I guess I'll leave it up to you to correct me, but it's probably part guess, part science, part art combined together, the three of them. And with that being said, then I want to ask you to give us in a nutshell what your report of many, many pages that came out a few days ago. Give us the nutshell, then I have a whole bunch of passages from that report that I want to dive into with you.
Sure, and I think that's a fair assessment of forecasting. Forecasting in essence is, let's say, educated guess, right? And you're using a lot of like models, a lot of kind of qualitative stuff, a lot of everything. But ultimately, it's always fluid, right? And there's certain kind of environments where the situation's even more fluid. And we can do a bunch of scenario analysis. We can look at, in our report, we have like risks to the forecast, right? And in times where unpredictability is the norm, it's really hard to forecast, but it's still very valuable to put a forecast out, right? Because if you're trying to guide your way through turbulent waters, like a flashlight's still better than nothing, right? So you're on point with like forecasting there. So in terms of this report, broad sense, the situation's still, again, fluid and a bit tough, and is largely dependent, at least if we're starting at the pure macro level, and then I'm going to drill down to what that means in the GTA. It's largely dependent on CUSMA negotiations, right? And the effective tariff rate that we face, and that impacts Ontario. Luckily,
can you elaborate what's CUSMA for those of the audience who don't know?
That is our NAFTA 2.0 trade agreement that involves the US and Mexico. So that is kind of what's up for renegotiation. Currently, it protects us from a lot of the tariffs that are being imposed on us right now. I think because it's an estimate, but a lot of analysts estimate the effective tariff rate something at about 6% now that we're facing nationwide for good exports to the United States. Forecasters have that range being anywhere between, following CUSMA, 0% and 20%. So it's a wide range with very large impacts, but that's ultimately the elephant in the room right now. And that impacts certain CMAs in Ontario specifically more than others. Like luckily in the GTA, we're slightly sheltered from that. I believe some estimates have it that about 12.5% of our GDP is reliant to good exports to the United States, whereas like it can get up to 60% for Windsor, which is quite substantial. So the macroeconomic backdrop, there's just a lot of uncertainty that's impacting everything from the consumer to the business to the investor to everyone. And I'm sure you feel it as well, right? It's a funny thing because you don't need to even actually impose tariffs or act on certain trade threats. It's just the act of making that statement puts a wrench in the machine a little bit, right? So what does that mean for the GTA as a whole? Luckily...
Sorry, before you go to GTA, so let's talk about the national, right?
Sure.
So the biggest elephant in the room, as you said, is our southern neighbor. if what it is what they do or what they say they would do, which not necessarily are the same at all times. It could be different. And I guess the other part of that the comment you made is that depending where you are, which sector you're in, and what you do for a living, you could be affected between 0% or up to 60%. So it's very variable. Like at the end of the day, if you live in Windsor and you're fully affected by this potential tariffs or uncertainty for the tariffs, because you're right, like that's the other thing that we're seeing in the market is that a lot of people are just sitting. Like we've had clients or conversations that things ready and they were supposed to move, and all of a sudden they say, you know what, let's wait a few months, let's just see what happens. And it's there's no necessarily logical rationale behind it, as if okay, March 1st is something that's going to happen or not. It's just feeling, and it's feeling of comfort that people are not moving. And before we dive into GTA, what is a CMA? Sorry, you referred to CMA.
Certainly. So a CMA is like a term that like is used by Stats Canada law and us. It's just census metropolitan area, and it's just what it's almost synonymous with the GTA. Yeah, it's like the entire, not just the city of Toronto, but that include like Mississauga and Brampton and everything.
Okay, so then with that clarified, then let's dive into maybe talking a little bit on the provincial level, because what I read on the report was that basically BC and Ontario are hit the most. And I'm just going to come out and say it that for anyone who wants to go and read the report, that it's not a very fun read. It's a very somewhat somber read, if you may. But if you're in Ontario, probably worst case or worst impacted, or BC a little bit better, but there are parts of the country who seem to be doing actually good, and like even better than good. Can we talk about that a little bit?
So that's where I'd kind of have to shift my focus back to the GTA. So we have colleagues that are lead economists for each of these giant regions. So like I can't speak to as much of like how Halifax is doing it. And what I do know about these regions is if it's like relevant to the GTA specifically. So right now, when I was joking that the center of the universe within Canada, it is in that like we have a unique thing where we had like a structural kink in our supply chain, right? That there'd be softness in the condo market regardless of trade tensions, right? It's just now we're having that on top.
So that elephant didn't really cause this, obviously, and it has nothing to do with that, is what you're saying.
It has nothing to do with that specifically. It's definitely substantial and exacerbating a lot of stuff. It's if you had a bit of a tummy ache and then someone punched you really hard in the stomach, it doesn't help.
That wouldn't be a good thing. Yes.
No, it just adds on to the challenges. And before any of these trade tensions happened, like a lot of forecasters expected a lot of stuff to improve, even on the resale side, whatever. We still expected the condo market to be sluggish, but we expected broad improvements elsewhere. Now it's exceptionally hard when nationwide 70% or up of our good exports are to the United States. It accounts for something like 1/5 of the national GDP. This is like a very significant, so I don't want to downplay kind of the act of the kind of geopolitical trade tensions. That's definitely like a huge exacerbator but like the GTA market had its own kind of tummy ache to begin with. It just makes it's being made far worse now.
Okay, gotcha. So now let's talk about GTA. You made a comment earlier. You made two comments. One of them was GTA being the center of the universe when it comes to housing, and at least the work that you're doing, which is important work. And also you made a point about GTA being unique. Why is GTA unique?
So, and this is the perfect storm that happened during the pandemic, right? So during the pandemic, it was, and this is why it's so like important to mix qualitative and quantitative, and forecasting is really tough in like a global pandemic, right? Because that was a time where every forecaster's models was just breaking, like parameters that weren't supposed to be negative were negative, all sorts of just chaos, because it was relatively unprecedented, at least in the last couple of decades. So it was an interesting time to support the economy. Interest rates had to be low. So money was effectively free. During that period, or shortly after, because during the heat of the pandemic, maybe not so much, but there was a lot of immigration. We had very high immigration targets. And like the GTA is the center of the universe within Canada for attracting immigration. I think we get roughly like a third of all immigrants who come into Canada, just this one big kind of city or region. So we have very high levels of immigration, a lot of non-permanent residents coming in at once, very low interest rates. And then on top of that, we had an asymmetric recession. Like certain industries and stuff were impacted, certain were not, right? There were a lot of individuals who were potential home buyers that weren't really impacted at all. Like it was business as usual, except businesses from your house now. So those individuals also had high savings rates because it was harder to spend money, which is why it's funny. You saw during around that time, a lot of like luxury goods saw a huge influence, right?
Very
Everyone
true.
suddenly wants a fancy
Air
watch now.
fryers and sourdough bread cooking became a
Yeah,
thing.
that's fancy too. Yeah, everyone loves air fryers during that time. I bought into it. I still have it. It's right behind me actually. But so all of those pushed together, just the fact that like Canada did or the GTA did draw a lot of those individuals, it might have a higher percentage of employment in sectors that weren't as negatively impacted, etc. So you saw a lot of condos being built, and we needed that housing, especially there's a lot of immigrants, a lot of non-permanent residents coming in. The investors can rent those out too, etc. And investor activity drives a very large amount of condo construction. I think if we look at our rental market survey, about 40% of condos in the GTA are rented out, and that's a good proxy for an investor, right? Because they're not owner occupying it, right? They're renting it out. So put all of those together and we just had a very large influx of condo construction, and it's led to a supply glut. And that's a funny kind of term to deal with because we have a supply glut of a specific unit type amid a housing crisis, right? A housing
Yeah,
affordability
it's
crisis,
a
let's
very
say.
complicated situation.
Yeah, it's very nuanced, right? And it's one of these things that now we're just dealing with the fallout from that. We had record high level of under construction inventory, then we had very high level of completions. And kind of the one thing that really switched stuff around, like for the housing market, for everything, were rates going up, right? There's like a perfect correlation between the average resale housing price, and I'm sure a lot of other like new homes as well, going down the second rates started rising. And that's what we've been dealing with the last few years because now you're an investor, right? You're a condo investor. Your costs are going up, right? Your monthly outlay. And rents aren't going up that much because there's a lot of supply that's entering the market. There's a large inventory of condos that are getting pushed through. 40% are rented out. So you have higher monthly outlays, weaker rent growth. And then on top of that, you have weaker price appreciation. Because before the kind of play in the GTA was, okay, you're going to be an investor, you're going to have a rental condo property. It's going to lose a bit of money every month or whatever. But the price appreciation is just going to more than make up for it, right? So that's where you're getting that. And so now you're just not having that. The condo market, and we're still expecting it to see the kind of like softest growth going forward. So that's what makes us unique is it was just way more accentuated given the fact like that we have just even let's just say immigration, that huge influx and how it asymmetrically impacts the GTA. Like that has led to us to have this supply glut in a very specific unit type that ultimately we'll see a reversal, right? Because as we can get into pre-sales, but pre-sales are near non-existent, right? And it's for that reason that from an investor perspective, it just doesn't really make sense. And also a little kind of extra thing with pre-sales is you want to they're you they're impacted more so by broad risk, right? If there's like geopolitical trade risk and stuff like that, pre-sales
No, very
are kind
true.
of
Very true.
yeah, asymmetrically impacted by that. So again, we have this kind of supply glut in the condo market that was going to be specific or more accentuated in the GTA that we're going to deal with regardless. But now we have geopolitical like trade tensions and stuff on top of that.
You mentioned that we have this glut, and then at some point it's going to reverse itself, which kind of leads into one of the questions I wanted to ask you. To your point, we have a lot of units that are not family friendly, meaning they're small, they're sub 500 square feet or even larger than that, but they're not really suited for even a couple with one kid, let alone with more than that. What is your take on the long term? Because at the end of the day, we have them. Like it's not going away. Like we have them currently delivered, sitting empty in the market, or we're probably going to break the record of some sort this year. And maybe you have some numbers on that on 2026. We're going to get a lot of other units come to market as well. What is going to happen in them if you were to fast track, let's say 1 to 5 years from now, and say look at those particular class of product? Do you have any insights on that?
So I think that developers and the market was reacting to certain market conditions at the time to build these units, right? There was affordability constraints, a lot of immigration, a lot of non-permanent residents, et cetera. So it made sense, right? On the flip side of that, we have us millennials make up the largest population demographic now, and we're entering like peak household formation stage. So there's a huge demand for kind of units that could better support household formation. It's hard to have a household in a small bachelor unit. So that's going to be a specific market segment that's going to need to be filled. And that's why we're seeing a bit of a stronger demand in more dense low-rise housing, the single, the semis, the missing middles. Okay, maybe not the single, but the semis, the rows, the missing middle housing and stuff. That's where we're seeing a lot more kind of demand shift because that just has to be serviced. So I think the market's eventually gonna pivot to that and fill that need. The tricky thing is, and I'm sure like it is getting everything to work on the developer side, like the math to work, right?
Yeah, like that's very true. These days, those are very hard to make work. They were always hard to make work, except for a brief period when the condos were selling for everything you would ask for. But these days, obviously, condos are non-existent, and even rentals, a lot of them are hard to make work. I want to switch gears. I want to go into the report itself a little bit, and I want to talk about the report and different parts of it. And I do appreciate that not all of those sections you can comment on. But one of the things is basically that the report as a whole expects Canada to have a expected grow. Canada's economy is expected to grow slowly in 2026. And there are a whole bunch of factors that you just touched on. And then growth is projected to improve slowly in 2027 and 2028. What does slowly mean to you in the context of our market here? And maybe we go from there.
It's assuming that we have some level of tariffs and that there's some positive, like the status quo at least has to be maintained, right? It's going to be tricky, but in the current scenario, like we do expect the economy to recover a bit, more pivot, right? To make that change, to diversify, to roll with the punches and successfully do that. I don't know. As Canadians, we've proven quite resilient to a wide range of things going back in the last few decades, right? I think that there's a lot of stuff putting us in a decent position or good position to do that. But again, it's subject to all of those uncertainties. And we're at a time where uncertainties are at a extremely high level and constantly subject to change. It's a really funny thing when I'm going into to do presentations and stuff like that, and I have to like refresh Twitter sometimes. So
just to see who's texting what and tweeting
Yeah.
what. Yeah, that's quick. So let me rephrase that question in a different way. Back in around 2022, when we were working, we had projects on the go. I couldn't find a forming guy or a mechanical contractor or many other trades who would be even willing to price a project for me because they were all too busy. I hated that.
Right.
As a builder, as someone who works closely with developers, I really hated that feeling that I basically couldn't find anyone to do the work. So I never wish to go back to that stage, if you may. But at the same time, if you look at it from employment and the industry, that was probably one of the peak times we had in terms of how many people were working, the shortage of workforce. Do you foresee we're ever going to get back to that stage anytime soon? At least by the looks of this report, it doesn't look like it's going to be the next 3 to 5 years. Is it a good state to go back to? And if so, when?
So our report typically looks like 3 years into the horizon, and we can see just a little bit over that corner, given the supply dynamics. Like we know that the kind of under construction condo inventory is likely to get worked through, let's say, 2028 and onwards. And then that's where there's going to be like no new condos in the pipeline, given current replenishment rates, and we're going to have a market reversal. If we're thinking about on the employment side, it's going to be tough because what you mentioned, we had a time where, and I remember those times. I remember going to all those conferences and stuff, and people were saying it's so hard to find skilled labor. But now a lot of that labor is getting freed up, right? And it doesn't look like they're going to, at least within the residential construction industry, like the new projects in the pipeline aren't getting replaced, nowhere near to the amount necessary to keep those individuals there. So you're seeing a lot of individuals move industries or go to residential construction elsewhere. And what that's going to do when that kind of reversal happens is we're going to have a lot of friction. And this is why supply kinks aren't that great, because now we're going to have an extra hard time finding that labor because it's gone and it's moved elsewhere. So that's another thing that's quite challenging. In terms of were conditions then idealistic and what we should be going towards, like it's subjective, right? I do think that more housing is better. If we can get more housing, whatever market conditions get us more housing out there, it's fantastic because ultimately, again, we still have a housing supply shortage in Canada.
And the way I interpret that, what you just said for myself, is that there's potentially a scenario around 2030 that we want to go back to where we were, or we need to go back to where we were. But first of all, we probably don't have the capacity to do that as much as we did, and it will take a while for us to build up to that capacity again, probably. And it will be basically double whammy. We basically we want to push because we need it, and at the same time we can't get enough people. So it doesn't, it's exciting, but it's not promising, I guess, is what I'm getting. Like, at the end of the day, you will have workforce coming back, but it's also going to be challenging. And or maybe I'm just reading too much into it for the future.
I think it just shows that there will be friction, right? Stuff doesn't, you can't just snap your fingers and get condos out of thin air. The market has different motivations and drivers, and then people responding to it have their own motivations and ways that they can respond to it. And it just, again, highlights the kind of difficulties that arise when you have supply kinks like this. Like, ideally, you'd want supply to be more linear and predictable and responsive, but when you have these kind of kinks, we're left to deal with the fallout from them.
So can we talk about the kinks? Because I read the report a couple of days ago when it came out first, and I'm not going to sugarcoat it. It was quite depressing from the perspective of someone who's advocating for more construction and housing and more building. And then I read it again this morning, trying to prepare for myself for this. And so the first time I read it, it felt like I'm reading an autopsy report of an industry that has already died, and we're just saying, you know what, it's probably going to be dead for a while. And then I looked at it differently this morning when I was reading it again, and I think you touched on some of that. Is that it almost feels like we have intentionally, or I don't know, that's a part of the question. Did we intentionally put the industry into medically induced coma? Because the other way of looking at it is that, to your point, we have many levers that we could play with. And when I say we, I mean as a country. It includes the governments, it includes the Bank of Canada, so you have the population growth lever, which is the immigration. You have the interest rate lever, which is the Bank of Canada's policies. You have the good old foreign investment ban, whatever the title was, which the Trudeau government kicked in back in 24. It was a few years back, it was supposed to expire back in 24, I believe. Then it got renewed until January 1st, 2027, I think. So it basically prevents I can't remember what exactly it is, but it's probably non-permanent residents or foreigners to own family houses or semis or something like that, which cut a lot of investments into the housing sector, right? So there are multiple things that we could do something about as a country, as a government, as Bank of Canada, but it almost feels like we're not there yet. Is that a good assessment?
I can't really comment as much on individual, they should have done this, they should have done that. But I always viewed that like people always have the best intentions. The market's reacting in a certain way. There's a lot of reasons certain things were done. Like during the pandemic, you want any sort of environment where there's like hardship on the economy, that's where you lower interest rates, right? And you're constantly playing that balance between inflation and, let's say, unemployment, right? And this is like a global phenomenon. Like everyone who had, a lot of countries are dealing with the kind of like post-pandemic inflation that was necessary to keep stuff afloat during the pandemic, because once productive capacity is destroyed or leaves or whatever, it's hard to get it back. It's easier to keep it on ice and then get it going there. So that's one thing there. In terms of population growth, there's in economics, there's no such thing as a free lunch, right? You have to always do this tightrope walk of, okay, we need immigration's fantastic for countries. It's great to have immigration. You want all sorts of skilled labor to come into your country. That's something that our neighbors to the south have a huge benefit of, right? There's like a global brain drain, and we even lose a lot of productive individuals from Canada who go to the south because there's paying opportunities, right? So you want immigration, and you want your population growth to be a certain number to benefit the economy, but that comes at the cost of other stuff, right? Now there's more housing demand, and are we like, how are we reacting to that and stuff? So it's like this pretty complicated balancing equation. I think that if you're trying to make the decisions based on kind of the information available at the time, I could see a lot of the rationale that got us here, right? Like even when we're talking, because you'll hear people say, oh, like, why did they develop all these small units? Like it made sense at the time, right? Like the economics of it, the demand, everything. So we got to do the best for where we are when we're there.
Yeah, no, I 100% agree with you. I guess my point was, and again, it's not pointing fingers, we're all in this together as a country. It's more so toward, because again, going back to the report, when we talk about that we're at decade low in construction, we're decade low, or sorry, in new starts, or decade low in transitions and sales and pre-construction. So one way of looking at it is that's to say, you know what, we're doomed. This is an industry that is basically collapsing in the next 3 years and nothing's going to happen. Go find work elsewhere. Or is there a way, or is there a potential movement or initiative from different levels of government that say, listen, like some of this we have control over, some of these levers we can start pulling. And maybe that's what Build Canada Homes is going to do,
Right.
or to some extent, right? Which, quite honestly, I'm hoping that's the case. Let's zoom back into GTA. I went as part of the report. Basically, my interpretation was that 2026, it seems that the data is showing you that 26 is probably the bottom in the foreseeable future in terms of pricing. Maybe let's talk about that a little bit. Is that correct?
We definitely have prices declining in 2026, and we're expecting to see a bit of a growth at least start in 2027. And that partly has to do, let's say, even on the condo side, with kind of like the supply pipeline and how it's getting worked through and stuff to go back. Ultimately, we hope there'll be more economic stability and certainty, because we are at the peak uncertainty, because this whole CUSMA revision, right? That's quite substantial, and that's a big kind of fork in the road. Kind of our largest trading partner. Again, roughly 70% of our good exports nationwide go to the States, hopefully. And that is playing a very substantial role in the market, in that there is demand. There's a lot of demand. That's the silver lining. There's a lot of individuals who want homes. There's a lot of individuals who are waiting on the sidelines because for whatever reason, like you want to see how things play out, especially if you're employed in a sector that could be impacted by all this, right? Like making arguably the largest purchasing decision in your life, the average person is going to be a little hesitant, right? So that is going to be the driving force that explains our kind of price growth or kind of recovery going forward. On the sales side, it's a little funny. Like there's kind of nowhere to go but up when you're at a quarter century low.
I guess that's good news.
Yeah, it's definitely like glass half full, right? Perspective.
It doesn't get worse than this.
On the price side too, like I do think because the condo market, it's just like a domino, right? So it impacts low-rise housing a lot as well, simply because it puts a lot of friction for move-up buyers, right? Because a lot of individuals, they go up the housing ladder in the GTA. They don't just buy a single detached property right away, right? Like they get a condo, they sell it, they get a townhouse, they eventually sell it, they save up more, they get a single detached home, whatever, right? So there's a lot of friction in there now because it's really hard to move a condo right now, specifically, like that specific unit.
Very true.
And it's quite interesting because if you look at like price declines from their peak, condos are fairly comparable to the rest of the housing types, which is interesting in terms of like their value from their peak to now. It's just the market's more sluggish. And part of the reason it didn't like decline further is it's still the first entry into home ownership. It's still the relatively affordable option. And amid like kind of economic uncertainty and affordability challenges, that helps it, right? But there is a oversupply in the specific unit type, so that just makes it harder for people to liquidate their assets so they can move up to a house there. So I do think as there's more economic kind of certainty, we're gonna see that recovery flowing in through the second half of our forecast horizon, and that's going to be a positive thing. And eventually, there will be like supply challenges simply because the construction pipeline's a bit predictable, right? If there's no pre-sales now, we have a decent idea how starts are going to look in the next few years. So eventually that will happen, and there will be that demand for the labor, for everything. I'm a little optimistic in that sense. I think that if you have a longer outlook, things are a bit more rosier, right? But if you zoom in, the narrower you get, the more kind of the more those rosy
it becomes.
Yeah, the rose tint fades a little bit but again, we'll see.
So you mentioned, first of all, I'm happy that you're optimistic, because there's a line in the report which didn't sound too optimistic. There's an alternative scenario section in the report. And it starts with saying the downside risks to the outlook are more likely than the upside risks, which to me, that means that if we made a mistake, it's probably we're being too optimistic. Maybe it gets worse than this. Is that the right way of reading that line?
Depends. If I'm adding like hypothetical probabilities, it could be like 70% confidence in our baseline, 20% in the downside, 10% in the upside, right? That's double the relative size. But for sure, I don't think that it's hard to imagine a scenario where Kuzma gets renegotiated and it's just twice as good for Canada as it was before in the
Yeah,
previous, I
that
don't think
doesn't that's
I
gonna
don't
happen.
think our neighbors to the south have such an altruistic motive for us, right? To renegotiate it. We didn't get
Definitely
a
not.
fair shake. We deserve more. So I don't think that's evident in
When
anything.
was the last
Even,
time that happened?
yeah. That's the challenge there. And it's unfortunate because there's, it's just the reality of it, right? I'm still pretty optimistic, but you have to say call it as it is, right? This is a large shock. If you tell the average person on the street that 70% of the nation's goods go to America, 20% of our national GDP roughly, and that's being jeopardized quite substantially. That's big. Like any economist, that's huge. That's why it's like the single most driving factor in our outlook, right? That's the main forecast risk. But again, at least we can take solace in the fact that this isn't isolated to the GTA. It's not even isolated to Canada.
I
This is
was
a
just gonna
global
say it's not.
phenomenon.
Yeah, it's not even isolated to our continent. That's,
Yeah.
I guess, there's a silver lining there.
So like the pandemic, at least we're all in it together.
They were all in it together with the broader sense of that sentence. Okay, so we talked about the past, we talked about the potential future. Let's talk about the present. Okay. If I'm a developer, if I'm a smaller, mid-sized developer in the city of Toronto or in the GTA area, and I'm trying to plan or come up with contingencies for next 3 years of my portfolio, of my projects, of my investments, what are the first or second or third items that you would suggest I should stress test against? What are some of my assumptions that I should go back and double check for the next 3 years, that these are the things, these are the areas that I might be most vulnerable to? We've kind of established that the next 3 years, probably there's not going to be condos going to market. So I'll take that off the table right away, which is probably kind of obvious. But aside from that, let's say I'm working on PBRs, let's say I'm working on missing middles or that types of projects. What are the three top things that I should be stress testing for?
Well, I think it's hard from an operational sense. I think that there's a lot of advantages to producing this type of housing right now. Like you mentioned missing middle. It's some way of getting supply that's relatively more dense on the market with less risk than condos have right now. And less barriers even, because with condos you have to hit certain sales thresholds that are just not getting hit right now, period, from an investor's perspective. I think there will be demand for these. Like I think a lot of industry stakeholders that I speak to, they're quite optimistic in the kind of long run, right? This is, if you have a longer kind of perspective on stuff, like it's good to have that perspective, and it definitely helps temper assumptions, or not assumptions, but the short run could be a bit bumpy, right? In terms of specific things to look for, it's it's quite challenging. Like what maybe I can flip that question back to you.
By all
Yeah,
means,
yeah,
do
yeah. So
this.
so what are the three things that you'd be like as someone going
Fair
to,
enough.
yeah.
So, like, one of the things, let's say if I'm doing a performa on a multiplex project or a mid-rise project where I have 30, 40, 50 units, and because I kind of feel, to be honest with you, that we're not going to see 400 unit purpose-built rentals happening anytime soon. So let's talk about between 6 to 60 units. Like the criteria that are going to really affect me are going to be, I guess, I'm just going to top my head. Vacancy is going to affect me very much. My growth and the base rent is going to affect me quite a bit in the next 5 years. And obviously the base rent, what I'm going to collect, what am I going to start collecting? We had projects that people were underwriting rents for like $6 a square foot or $5.50 a square foot, and then when time came, people couldn't pay more than 3.5, and then like that. So those are top three things which I think overall affect our NOI quite a bit.
So I think on the vacancy side, we are expecting it to peak this year and kind of see recovery there, which is consistent with our overview. Of course, rent growth will be a bit subdued too. But if you're looking at a 3-year horizon and then a 5-year, like it's not that far off if you can get to that supply, that kind of market inversion that is eventually going to happen. Because quite interestingly, like it's okay. So if you're thinking about rental demand, the GTA is losing a lot of non-permanent residents with the new kind of national policies around immigration and non-permanent residents. And actually, we haven't seen in the data the brunt of that, because right now we're looking at 4 quarter data for the CMAs between, I think, 2024 Q3 to 2025 Q2, right? And we saw for the first time in the GTA, like a net loss in migration of like roughly 24,000 individuals, I believe. We have the provincial data, which goes to Q3 now. And Q3 is like the largest decline in NPR residents. So that's going to happen in the GTA. However, we had that huge influx that came before, and it impacts different regions within the GTA a little bit more, a little bit less. But the one thing that is positive is immigration targets now at the federal level are still higher than they were pre-pandemic. And we still get a lot
Right.
of those immigrants, right? So we still get roughly 30% of those. And there is a lot of demand pushing stuff back towards the GTA, that return to office, let's say. So there are like positive factors still there. And ultimately, again, I think a lot of like rental housing providers, they have a much longer outlook horizon than condo developers typically, right? And you can see kind
Well,
of the
that's very
way
true.
the supply is going, and the GTA is still going to be a big draw for individuals and a lot of migration. And whatever we're losing individuals, let's say, to the rest of the province, and that's just like affordability, migration, stuff like that. And that kind of exacerbated in the pandemic simply because people wanted to see less of other people in the pandemic. Typically, you
True.
wanted to move into the
Yeah.
suburbs and stuff, and you're seeing a bit of a pullback from that too. So that's going to help support demand there. So I think if you have a longer horizon, like the rental outlook is quite favorable.
So we were talking with a friend of mine who's also a developer, and we're basically the short version is try not to die for the next 3 years, and hopefully in the five you'll do good, and keep above the water for the time being, and we will survive. Okay, so I'm gonna go a little bit more granular in that. Like you said, some of these data, the reports you guys are producing or other entities are producing, is basically there's a lag. The people are looking at it and I'll see. So if you were to advise a developer or an investor in terms of looking at or checking lead measures, like what is it that we should be checking on individuals and not have to wait for your reports or other people's sophisticated reports to come out? What are some lead measures that are good for people to check in the market every day, every week, every month? Better sense of what's about to happen. Is that a fair question even to ask, or is that too much to ask?
It's tough. I was going to make a joke and say Twitter, but who
That's probably
knows?
not a bad one.
Who knows what you can infer from that even though, because there's just a lot of noise. But, I think it's good to, keep your ear to the ground, hear what's going on, but never lose sight of those like huge kind of trends that are much more predictable. We do see that the construction pipeline is going to get worked through and cleared, right? Like the under construction inventory. Start planning a strategy around that would make sense, right? Like that's something more predictable and like more structural and I guess like in our control, right?
Okay, so I guess try to write the next wave is what you're trying to say, like or prepare for the next wave, if that makes sense, and see, because it's hard to put numbers or dates to exactly when that is going to happen. So try to keep on top of the existing inventory. These are reports that come out every month from real estate boards in terms of how much sales has happened and how much inventory
Right.
is there.
Just to add to that, like we have monthly data for housing starts, completions, all sorts of stuff that's very kind of recent, which you can follow. You can see what new projects are starting where. And if you want to go even before that, you can look at permit data from other providers. But it's good to see where the inventory is getting worked through, where it's not, and factor that into your equation. But ultimately, this is a question that like developers are much better able to answer, right?
Fair enough. So going back to your reports and your data, is there any particular criteria or something that you guys measure and report on that you think is underrated? Like people are not paying too much attention to. We hear a lot about pre-sales of condos and new transactions on new construction. Is there any other measure that is not being noticed as much as it should, in your opinion?
Ooh. I was asking me which I don't have children, but if I did,
I
it's
was
like
just
asking
gonna
me which
say,
one's my favorite.
which one's
So,
your favorite? Which one is your favorite?
I'm as a CMHC spokesperson, I'm a fan of all of our products equally.
Like
But
I like all of my kids. That's the
yeah,
say same thing.
if maybe not, maybe love is the stronger word I think most parents or the more diplomatic word parents would use.
True.
But I think we offer like a very wide range. We do. So we have our housing market outlooks, which is like quite comprehensive nationwide, and we used to do that at least recently on an annual basis. Now we're doing a major analysis and then a summer follow up like we did last year. Same with the rental market, right? The one thing that's maybe underrated are these new reports that we're putting out and saying, hey, look, we're very actively monitoring the situation, much to the detriment of the mental health of the economists who have to cover stuff. But it's something that obviously we have an active duty to follow everything quite closely. And these kind of newer reports, I definitely recommend checking out. Last year, we did one showing the condo market risk, right? What's going on there? And on that note, we had a mortgage delinquency or like a mortgage report just recently that showed that Cs are getting higher in the GTA, but they're still low from a historical sense. And while it is going to put a lot of pressure on current owners who have to renew their mortgages, we're quite resilient. And luckily, we had more stress testing to account for that. So that's paying dividends now. But yeah, I just check out all of our kind of new topical reports because it's our duty now. This isn't business as usual, right? This is
Very true.
a lot of individuals are not a lot of individuals, but I think it's quite a fallacy to just walk around and pretend that this is business as usual. So we have to adapt. And in the CMHC, the way we're doing that now is we're really just trying to monitor things more closely, produce stuff more frequently, and get creative with our analysis.
You made a joke about the mental health of the Economist. When I started podcasting a couple of years ago, I didn't think that would be an issue for podcasters, but that's the same thing because every episode we have, we're digging for good news and it's becoming harder and harder and harder to get it out. And hopefully there's an end to that. I want to zoom out. We talked about particularly in GTA, condos, rentals, and everything else. If you were to forget about your role at CMHC for a second, if you could, and look at Canada as a economist, as someone who understands economic forces, are there any long-term trends that makes you excited? So if you were to have kids at any point in time, you would be excited for them.
So the one kind of silver lining of this shakeup in the way we operate in Canada is that there seems to be a very enhanced focus on how can we on nation building, right? On just strengthening the
Coming
country.
together.
Yeah, and working to make Canada more stronger economically. Because I think we took our position maybe for granted, let's say, in the most broadest sense. And this is the opinions of Jordan Nanowski, the individual, not the economist per se, but still I'm an economist anyway, I'm always an economist, but yeah, for better or for worse. But I think that there's an excitement of look at all the cool stuff we can do if we put our mind together. And now it really matters, right? Because when there's a bit of when stuff gets shaken up a bit, you get sobered up a little and you're like, okay, now let's focus, let's get stuff done. So that's a silver lining of the current situation. And while we're in the turbulence now, I'm fairly optimistic for the future.
So is it fair to say that, and I'm going to say it in my layman terms, not in the economic terms, that we're getting a little bit too comfortable and now we got a wake-up call and hopefully the future is brighter because of that. With that being said, I want to start wrapping this up. We have a closing question on the podcast that we give you a magic wand for about 5 minutes. And if you had a magic wand, you could change one law, one regulation, one mindset, one paradigm, thinking paradigm, and or anything for that matter, to help us weather these next few years that we just talked about quite a bit. If you could make one wish, what would that be?
I don't want to be too repetitive and harking on the whole geopolitical situation, but it's hard not to, in the sense of it's hard to think of a specific ideal response or policy or anything to deal with all of this. Ultimately, if I had access to any sort of magical object that could influence unilaterally something, it would just be to normalize trade relations and have more stability in the economy, just because ultimately you see all these things it impacts. Its tentacles are in everything, right? All the way down from the business, from the investor to the consumer, to everyone, right? And it's just causing a lot of economic friction. So I wish I could point to a specific housing policy or a specific thing that would counterbalance that in a very meaningful way. But ultimately, even in our forecast report, that is the big, that in itself is the big driver between kind of a slower recovery or a faster recovery. Yeah, if I had a magic wand, I'd take us back to more normal, predictable trade relations.
Back to more than 1 year ago when we had more certainty about the environment.
Seems like a different world completely.
I know what the impact of a year can have on everything. And to your point, the report started by pointing out that our projected GDP growth for 2026 is only 0.7, which is sad. Which it's still good that we're not in a full-on scale recession from that perspective, but it's also for a country with our resources, with our capabilities, it's a sad passing ground. Hopefully, we pass through it quite quickly and in the near future. Thank you, Jordan. Is there anything that I haven't asked you that you wish to share with our audience before we log off?
Just to maybe end stuff with a bit of like silver linings, a bit more of a
Please
positive
do.
spin, because again, like I get it's exhausting to cover current events and how it all plays into the data and what we're seeing there and how it impacts everything. But ultimately, I really want to say again that we have a pretty good track record here of dealing with uncertainty and stuff. You look at the global financial crisis, you look at a lot of stuff. We've done quite well. Canadians are quite resilient. In the GTA, a lot of our homeowners or a lot of individuals, they've been handling things pretty good, pretty well. They've been playing like economic Tetris quite well. I think that we have a silver lining here again in the GTA that we're quite like it's not as much of our CMA level GDP as other CMAs in Ontario. So we're good on that. We're better on that front. There's certain areas that could be a little bit more impacted, like in our automotive corridor and stuff like that. But as a whole, as a CMA, like the GTA has a quite resilient economy. So I think that we will be able to weather this, and I'm quite optimistic in the longer term. And I do think that even from the market sense, we do see a light at the end of the tunnel, and we do see like a reversal in market conditions 2028 onwards. Just want to end stuff on a positive note.
I very much
That's it.
appreciate it. We're
Yeah.
going to get through this and we're all in this together, and just keep your cool. Keep, what's that saying? Keep calm and keep
Carry
building.
on. Yeah.
Yeah,
Or
we
that, or
carry
keep
on.
building your
Yeah, we will keep buildings. We're builders here. Thank you very much, Jordan. I'm
awesome. My
hoping that we
pleasure.
can have part 2 of this interview next time that you have a report, which is hopefully going to be more positive and have better news for us. And we go from there. Thank you for being
Fantastic.
here.
Awesome. Thanks. My pleasure. Cheers.